You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, everyone. Welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. We're powered by Quattro Capital today. I've got with me the man, Mr. Chris Odegard, fellow nerdy engineer. I seem to attract engineers on this show. It's pretty funny, but here we are yet again with another one just like me, if not the most like me yet. Chris used to be a conventional investor on the 401k highway to mediocrity with his investments. In 2009, he lost 55% of his assets and thousands of dollars a month in cash flow. Can't wait to hear that story. And by switching to alternative investments in 9 short years, Chris has recouped his 55% asset loss, multiplied it many times over, and became financially free. I love stories like this because it makes it possible and attainable for you as well. Chris, welcome to the show. How are you doing, friend?
I'm doing great. Thanks for having me on. I really appreciate it. Looking forward to it.
This sounds like we're going to have story time today, so I'm really excited about this. But first, tell me who Chris is. What's your background? How did you get into even caring about investments? And maybe then we'll lead into the 401k mediocrity.
Yeah, well, like you mentioned, I used to be like, well, you've probably got a mixture of people here. So I've been on both sides of the fence. I started off as just a conventional investor, stocks, bonds, and mutual funds through the 401k. And then you mentioned something about a loss and all that, but I'll go back a little bit just because we're both nerdy engineering guys. I started off I went to Embry-Riddle Aeronautical University down in Daytona Beach, Florida, to become an airplane mechanic, which I did. And then I went on.
Whoa. All right, guys. He's a super nerd. He went to airplane school. That's a really good school, by the way. Awesome.
And I managed to tack on a couple more years and get a Bachelor of Science degree. And I worked at the Kennedy Space Center when the space shuttles were first going off. And then I realized I'd spent 4 years learning about airplanes. I didn't know anything about rockets. So I got a job at the Boeing company in Seattle as a aviation maintenance instructor on the 737-300 avionics systems. And
Chris, hold on. I got to interrupt you and ask a question here. And only the nerds out here are going to get this. Were you working on the Saturn V rocket back in the day, or?
No, not. I'm not that old. Saturn V.
It took him a minute.
It took me a minute. The Saturn V.
Guys, that was like space race days. John F. Kennedy back in the day. But anyway, keep going. Sorry, man.
Yeah. Where was I? So Boeing. Anyway, I spent decades at the Boeing company, and at the end, I ended up being, at the height of my career, the director of contracts. And basically, when you're selling airplanes, you have a selling team, a marketing guy, a sales guy, and a contracts guy. I say guy, some of them are women person. And anyway, I was the contracts person. So I wrote, negotiated, signed, and delivered and received money on the airplanes when they finally came. And so, I've been to 30 something different countries, selling airplanes all over the world, including one royal family. And so it was an MBA on steroids. And so that's kind of that backstory. But in my mid 40s, around 2009, like you mentioned, I experienced this huge illiquidity event, and that's where you lose lots of money. And it was 55% of my assets and thousands of dollars a month in cash flow. In my case, it happened to be a divorce. There will be some people, men and women, who can relate to that, but it could be anything, bankruptcy. But it happens. And so here I am. I had been on the highway to mediocrity, and now it just got even more mediocre, exponentially. And so, something had to change. And around that same time, just kind of coincidentally, a friend of mine, he said, "Hey, Chris, there's this book you got to read." And he gave me the name of the book, and I bought the book, and it sat somewhere in the house for months, I'm sure. And finally, one day I was on a business trip, and I grabbed that book and I read it. And of course, it was Robert Kiyosaki's Rich Dad, Poor Dad.
He's a member of the club, folks.
Member of the club.
I love the Purple Book Club.
And it was just like it's the same old story. It's like a lightning bolt. All this different ways of thinking about money and investments. And so I was sold, and I started moving off in that direction. And I kind of completely, some people say, well, I've got 90% of the stock market and 10% in real estate. On the other way. I have to actually do the number because I'm probably 95% non-stock market and 5%. But, so I started investing in performing and non-performing notes. I had some small single family and multifamily rentals. I've done some private equity, and now I'm in your camp. I'm mostly a multifamily guy on the limited partner side. But so there we are, 2009, 9 years later. I'm trying to what I call fire the man, the Boeing company, and not that it was a bad ride, it was a great ride, but there becomes the point where you want to do something different. And I kind of, I had a balance sheet and I had bookkeepers and I was very organized as a serious investor. And I go, wow, I'm here now. It's too bad I didn't have all those records from back then so I could quantify, engineering type thing, quantify how far I've come. And then it struck me, guess what happens when you get a divorce? The lawyers make you do an accounting. So I went back and I said, oh, the records are there. And lo and behold, I had, 5.6 times. That's the number. I had gone from a negative 55% loss and multiplied that 5.6 times in 9 years. I retired from Boeing, never have to work again if I don't want to. And now I just enjoy, continuing to invest in real estate and do the blog at theprolificinvestor.net and write a book that I did and just help everybody else out there get off that 401k highway to mediocrity, invest in real stuff where they can, get to wherever they want to be earlier and faster.
What I love about your story, Chris, I mean, not only do we have a lot in common, I was also a NASA boy for a little while. I was at Marshall in Huntsville, also not in the Saturn V days, obviously, but, anyway, so, we both kind of worked a pretty rewarding corporate career. It was a lot of fun. I enjoyed my time at places like GE and NASA and things. You enjoyed Boeing, but we read a little book. We had a paradigm shift. We saw a different way. You had an illiquidity event, as you put it, right? Mm-hmm. And what's cool about this is, I think understanding the difference in conventional assets and alternative assets is something that you have done very well. And you're a pretty well-rounded limited partner investor, if you want to call it that, right? You're not the active syndicator or the one actually running the investments, but you're deploying money into things that are making you money. Right. Honestly, folks, when you get to where you have a little money, you're in the best position ever because, everyone needs operators, but when you're the one with the money, you have a lot of ability to go and make money without doing anything, and then you can really spend your time writing books and things like that. So Chris, I love that the example, how would you I guess maybe if we just overarch this a little bit, first, what would you say is the difference in an alternative investment and a conventional investment? Yeah. And then maybe we'll talk about what all different bricks you're into.
Yeah.
Right?
So it's really easy. So conventional investments are pretty much everything that's publicly traded. Stocks, bonds, mutual funds, ETF. Those are your conventional investments. Everything else is alternative investments. So that would be any form of real estate, cryptocurrency, private lending, private equity, business equipment. I do own some ATM machines. There's some ATM syndications out there, notes. And believe it or not, cash value life insurance is a great alternative investment that I feel should be the foundation of every serious investor's portfolio. But then, so that's kind of the two big dividing lines between conventional and alternatives. But there's 4 asset classes. There's paper, there's commodities, there's real assets like real estate and things you can touch, and then there's private shares of small businesses. So those are, or you could call it private equity. So those are the 4 asset classes. And the interesting thing is if you're a conventional investor and you go to your financial advisor and he's going to build you a diversified portfolio, you're in one asset class, you're all in paper. You've got no commodities, you've got no private equity, and you've got no real estate. So all the people that think they have a diversified portfolio, it's diversified in one tiny segment of the market called paper. And with paper comes counterparty risk, right? So I think, is that a good explanation of the conventional and alternatives?
I think it is. And to further point that out. I mean, and, our group is an alternative investment group. I mean, a lot of the people know us and know what we're doing, but we're focusing in a small subset of alternative assets. I mean,
Sure.
Chris just outlined a whole lot of other opportunities that are also not this little bucket that is the conventional asset. And by the way, they keep you in a little conventional asset bubble because that's where they can take their fees, right? And
Yes.
whether or not it performs or not, they don't care.
Yes.
So not saying anything bad about the individuals. They're trained to do what they do, but that's not where you want to be. So yes, why does that so what is the conventional investing wisdom, and why does it not work for what did you say, 92% of Americans in your book?
Yeah. So there's a couple of there's two kind of basic tenets in the conventional investing wisdom. One is just that you invest in paper stock, you build that diversified portfolio of stocks, bonds, and mutual funds, and you're building this mountain of assets. Because they're not cash flowing investments like what you and I do. You're betting on capital appreciation. So you're building this kind of mountain of money. So that's the one principle. And another principle is something called the 4% rule. And the 4% rule is the rule of thumb that financial advisors give to retirees and say, okay, you can sell off 4% of your portfolio every year, and you're likely to not run out of money before you run out of life, right? Because since they don't have apartment buildings that are, number one, increasing in value, and number two, throwing off cash at the same time, conventional investors have to generate cash flow by selling off this 4% of their portfolio. And so a lot of the conventional investors, the conversation is like, well, how big how much money do I need? Does that need to be 500,000, a million, 5 million? What does it need to be? And I think that's the wrong question. The question people should be asking is, what retirement income do I want? And then you use the 4% rule, and it'll tell you how big that amount needs to be. So let's say that you wanted to have a retirement income of $100,000 a year. So you take that 100,000, you divide it by the 4% rule, and that gives you a portfolio of $2.5 million. I'm talking about kind of a 401k portfolio. And so that's a pretty significant portfolio. So maybe we set our sights just a little bit too high. The median income in the United States is somewhere around mid-60s, $63,000, something like that.
That's about right.
So if we took the median income, and the median income probably works better in South Carolina, where I am, than Seattle, where I lived before, right? So you take that's 63,000, you divide it by the 4% rule. Now you still got a $1.575 million portfolio. But the problem now, it gets even better or worse, because what the financial industries is finding out is that the 4% rule isn't working anymore. Now it's more like the 3% rule. So you take your 63,000 and divide it by 3% now, and now you're back up to a $2.1 million portfolio. And what percentage of the population ever achieves millionaire status? 8%.
8%. Wow.
So this whole system that requires a multi-million-dollar portfolio in order for you to have the median U.S. income requires you to be a millionaire. So therefore, ergo, it doesn't work for 92% of the population. So we're all on this highway to mediocrity, and that's exactly where we're going to end up. And most people don't realize how big that number needs to be. Now, if you've got pensions and other things like that, but especially I've got kids that are in their late 20s, early 30s, and they don't have any of that kind of stuff. And so this is what they're looking at. And this is really important for not our generation, but the one that's coming behind us, because they're going to have a harder time than we did. They have to be smarter at a younger age, I think.
I think you're right. And everything you just put, it's kind of a mic drop moment, what you just did there, because you basically said anything that you're being advertised at or shown to put your money in, is probably not working. It's probably not going to get you where you want to go. And so fortunately, we're in a time where we have podcasts, we have the internet, we have YouTube, we can actually go and educate and improve our own financial acumen, which is and guys, there's a lot of books out there, like the one we're going to talk about that Chris wrote a little further in this episode. even if you haven't read Rich Dad Poor Dad, Robert Kiyosaki, pick it up and read it. It's a paradigm shift. It'll blow your mind. You won't believe it. You'll probably throw it away in the trash, and you'll pick it up again and read it when you're ready to accept it. But it's the truth, and people like Chris and I have gotten into that mindset and learned it. So that's very interesting. So I guess, to kind of conclude, we've talked about why that investment strategy doesn't work and how you really have to start, like, instead of thinking about the nest egg, right? Everyone sells this nest egg idea. It's like, okay, well, you build this egg, and then at some point you got to start eating the egg. So let's pretend it's a boiled egg, not a cracked egg, right? So it's a boiled egg, and you got to start taking bites out of it, and you hope you don't go hungry by the time you die, right?
Yeah, right.
Well, guess what? Medicine's improving. I mean, we're getting to where the heart is not what's killing people now; it's the pancreas, because people are living longer, and that's the next thing to go in the mechanics of life, right? So who knows what it'll be when we're at that age. So you have to start thinking about this as building rivers. You want to go build a stream that you can walk out there with a ladle and take a freaking drink whenever you want to, right? Not a nest egg, know? So anyway, just to kind of conclude before we get into a couple of questions that we typically get into, Chris, maybe kind of talk through the examples of alternative assets that you're in. We can take a few minutes on this and just, why they benefit you. Like, why are you investing in commodities? Why are you investing in performing debt notes, things of that sort? And let's kind of just because I think everyone understands real estate for the most part, but let's talk about the other stuff you're in.
Excuse me. Well, I'm
sorry to put you on the spot, by the way.
No. I'm trying to think of let me try it a different way. So I'm primarily in multifamily, self-storage, ATMs, and cash value life insurance. That's pretty much what I do now. A lot of the stuff that I've done, the real estate guys, if you ever listen to their podcast, one day they said something that just, another Robert Kiyosaki moment. They said, periodically, let's just say every year, you should look at all the assets that you own and ask yourself, knowing what I know today, would I rebuy those assets again? And in my case, hands down, everything that I had done, there was a lot of dead ends, and it took me a few years, but I unwound all that stuff, and I finally landed, where I fit. And I love the performance of the multifamily. But in the book, I created something called the hierarchy of investors, and it's like a pyramid. Not a good example, pyramid or a triangle, and in the bottom is of the shadow of this pyramid, where it's dark and damp. That's where all the conventional investments are. The conventional investors are down there. And then as you get on the pyramid to start climbing, that's where all the alternatives are. And what I did is I compared conventional investments and alternatives across 13 different categories to see which one won that particular category. And alternatives win in 11 out of the 13. And there's one neutral item, and then there's, it's 11, 12. Anyway, we win 11 out of 13, whatever it is. And so some of the advantages are things that you get from alternatives that you don't get from conventional. Number one, you get cash flow, right? You get way higher returns. The S&P 500 over its history has produced an average annual return of 9.8%. You and I regularly get returns in the 20+%. Matter of fact, I just had a liquidity event on Monday on an apartment building with a 27% average annual return. And guess how much taxes I paid on that income? 0. That's another thing, taxes. Alternatives have built-in tax advantages called depreciation. And you being a nerdy guy, let's talk about a physics formula. Force equals mass times acceleration, right? Well, if the force is equal to building your wealth, the mass is how much money you have to invest, and acceleration is you just keeping that money moving. Well, we all run out of mass, but guess what you can use with alternatives? You can use other people's money. You can get bank loans. You can't go out and think about going into a banker and say, hey, I'd like to supercharge my investing. I'm going to invest $100,000 in mutual funds. I'd like you to loan me $70,000. Not going to happen, right? So anyway, there's like I said, 11 out of these 13 categories are all in favor of alternatives. So what you and I can insure our assets, right? We can, right. You wouldn't think of not insuring your house, but people have more money in 401ks that are completely unprotected and uninsurable. right? So, I mean, what do bankers and insurance people know about conventional investments that they're not worthy of lending against and they can't be insured? So anyway, those are just some of the the advantages that I go through in the book, and I use the ATM machine as an example, and the reason is because it's just a fixed monthly payment that I get, so it's just really easy to do the math. And anyway.
Yeah, so that's probably one of your more cash flow heavy investments, I would say. Probably not a big equity play, but it's definitely a cash flow play.
Yeah, it's a depreciating asset, so that's just something. It's kind of like a used car. You just got to know you're going to get it's like a really high paying annuity for like 7 years, but at the end, it's worth whatever it's worth, and you sell it. So if you spend all that money along the way, you just got to realize there's nothing left at the end.
Yeah, that makes sense. Well, fantastic. So, okay, I'd love to talk about this all day long, Chris. I feel like we could keep going on these alternative assets, but let's get into a couple of the questions here so we can find out your answers, and also talk about this book a little bit, because I think it's a must read for those who are looking to, we'll say truly diversify your investments, not just a conventional portfolio. So, Chris, okay, what is your superpower as it relates to your business, profession, or lifestyle?
I think my superpower is taking complex things and bringing them down into like a one-page kind of infographic. This is the hierarchy of investors, and all the stuff that I talked about is on there. I could spend 45 minutes just talking from this slide. This pretty much goes you through everything that there is to know about the differences between conventional and alternative. So that's my superpower, I think.
That's fantastic. Yeah, I love that infographic. I'm gonna have to figure out where I can get that.
It's on the website in the resources page.
Awesome. And folks, we'll get down to the website here in just a minute in the show notes. So what is your biggest failure, and what did it teach you?
So when I was first on this journey, I was very enamored with private equity. So this is buying private shares of small businesses. And as we've all heard, the majority of startups fail. And I made the mistake of putting too much money in too few of these companies. And one of them has already failed, and the other two, were kind of teetering before COVID. And so I think that I believe in putting a percentage of my portfolio in what I call the swing for the fences, the grand slam, whether that be crypto or these private equities. But I know now that it needs to be smaller amounts spread across. It needs to be more diversified. So it hasn't been a total disaster. I've certainly learned something, and I still got a couple players in the game. And if one of them, hits a home run, that'll pay for all the other ones. So that was one of the mistakes I made early on.
Fair enough. I mean, I think the most important, especially if you're playing in any sort of private investment, due diligence is the two most important words in real estate or anything like that. It's hard to you have to assess your risk, because sometimes it's hard to, you can look at the big rosy projections and they may really hit it, but to your point, you got to think about failure rate too.
Yeah, right.
So it's very good. Okay, let's talk about this book a little bit. So you've written a book. Let's talk about what it is, where we can find it, why these guys should read it, because I think they need to.
Yeah, it was the book is titled "Get Off Your Ass and Manage Your Money: Why You Need Alternative Investments." It was released last November or December, and it's available on Amazon exclusively. And I wrote it because my path from conventional investments to alternatives to financial freedom, like with the private equity, was one step forward, 3 steps back, 2 steps sideways. It was a very jagged path, and I thought, if I wanted to take somebody who was like me back then and give them the information of why they should be doing it and how, I could save them a lot of headaches. And so that's why I wrote the book. And so I go through the 4 asset classes, the hierarchy of investors, and I talk about each one of those different 13 attributes and whether it's better for conventional or alternatives. And I use the real numbers from my ATM. So when I'm talking about each one of these attributes, ROIs, well, here's the actual return on investment, or in this case, I think I used an IRR because it's a cash flowing investment. And so I talk about it in general, and then I apply each one of them to the ATMs to show how this actual investment performs. And the problem with this kind of stuff is that it's not like conventional investments. You can't say, well, just go buy, so-and-so's, balanced mutual fund. And, it's really, all I can do is kind of open like Robert Kiyosaki, not that I should be comparing myself to him, but all I can do is kind of open your mind and convince you that this is a better path and give you some resources to get started. You have to start surrounding yourself with the people, reading the books, listening to the podcasts, going to the conventions and seminars. And then if you do all that, you will, out of all the alternatives that there are, you will find one that's right for you. But unfortunately, I can't tell you what that is. That was actually a criticism of the book as well. They want me to give them the answer at the end of the book, and you have to find the answer for yourself. It's kind of a process, a discovery process. So if for anybody who, is either questioning, being in the stock market, or, doesn't believe me and wants to see if I know what I'm talking about, I mean, it's a great book to kind of give you all the ammunition to kind of move down that road. There's lots of numbers and charts and graphs, and it's in color, so it's all really cool.
So it's only pictures. So for someone like me,
there's, okay. And it's it's 120 pages or something. This is a 2-hour read, so but definitely well worth it.
Yeah, fantastic.
In my completely objective opinion, right?
Folks, what I love about it is it's practical. There's some numbers in there, and to Chris's point, this is not something where we're not financial advisors. We're not going to come to you and say this is the balanced thing that we've curated for everybody and it should fit everybody and this is what it's going to fit. It's not that way, right? You're going to have your own risk tolerance. You're going to have your own hopes, dreams, desires. Maybe you want more cash flow. Maybe you want more equity upside because you have a good job right now. We can't answer these questions for you. What we can do is, give a man to fish versus teach a man to fish, right? Or woman in today's society, right? So you can either way. Just you have to go through the exploratory process and read this book, because this is going to kind of branch you out a little bit more, not just in real estate, but other types of assets and kind of where they rank on the pyramid. I'm excited to go read it myself, actually. So thank you for that. That's available on Amazon. And again, that is Get Off Your Ass. By the way, it's not a cuss word. It's $. So get off your ass with money and manage your money. Why you need alternative investments. So get that anywhere on Amazon. Fantastic stuff. And it looks like also on your site, you have some free downloadable resources we should chat about.
Yeah. So just a quick question on about the book. So if you go to Amazon and you type "Get Off Your Ass and Manage Your Money," it might take it. If you just type in my name, Chris Odegard, the book will come up quicker. And then also on the website, on the prolificinvestor.net, there's a link right there. So those are a couple of ways to get there. But yeah, there's downloadable resources. There's all the I typically write an article every month, so it's been about 45 or 44 articles there. Sometimes there's a video with them, sometimes there's not. And I've got a page full of resources, podcasts and books and some of the investments that I do or have done, and some of the people that are, even in some cases, something that I haven't done, but somebody who's got a good reputation in that area, if that happens to be something that might work for you. So
that's really good. So you may not give them a curated example, but you may have some connections where they can go find when they a source for that type of investment. Because you won't always find it on Google.
Yeah.
So fantastic. Well, I think that, and all of that will be in the show notes, folks, by the way. So that's the prolificinvestor.net. Scroll down from this episode. You'll see in the show notes. If for some reason Apple's been cutting off show notes lately, click on episode website and they'll all be there, shiny and ready for you to click on. So
before you go, there's just a couple other things. So I have there's a coffee cup on the front page. So anybody who wants to have a free virtual coffee with me for 30 minutes, you go there and click on that. You can pick a time on your schedule. And I set aside Thursdays for anybody who wants to kind of do that. So it's always, it's nice to read a book and see somebody or listen to them. But if you want to have a Zoom call with me and tell me where you are and where you're trying to get, like I said, like we both said, we don't give financial advice, but I can tell you what I know and share my experience. And there's also a conventional investment quiz there. It's a 10-question quiz. You can do that as well, and it'll be a little eye-opening, I think.
I like coffee. Is that open for me as well?
Absolutely.
Fantastic. Well, Chris, last thing here in the episode, we at Quattro, one of our 4 pillars is philanthropy. I'd love to give you an opportunity to mention any philanthropies that you are contributing to, so that perhaps our listeners will contribute alongside with you.
I'm always, I don't know if I have them. I'm always kind of drawn toward things that have to do with veterans and children. And let me find the one there's a medical team that goes out around the world, and I just don't have it on the tip of my tongue.
No worries. These guys will edit out the space, so we're good.
Yeah, I will get it to you. How's that?
Okay, fantastic. So we'll look for anything that supports veterans or children, and scroll down to the show notes, and we'll let Chris give us the surprise philanthropy that he's been contributing to. Fantastic. Yep. Well, Chris, thank you so much for coming on the show. It's fantastic to just, chat with not only other operators, but other investors who aren't really the ones actively running the show here, but, are the ones actually reaping the benefits out of these investments. And it sounds like you've, really almost fully exited the conventional portfolio, and you have a arsenal of alternative investments that have really treated you well. So congratulations, sir. Thank you for coming on the show.
Thank you. Had a great time.
All right, everyone. This has been another episode of the Real Estate Runway Podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.